and welcome. Thank you for joining us today for this timely discussion hosted by the Gulf International Forum on strategic risks and energy market impacts of the Iran-Israel conflict on the GCC and global economies. I'm Rachel Ziemba, a non-resident fellow with the Gulf International Forum and senior advisor with Horizon Engage. With U.S. strikes on nuclear facilities over the weekend and as we speak, retaliation beginning from Iran, this discussion is even more timely. Our panelists will not only respond to what's happened so far, but leave us with some signposts about what to watch going forward for what remains a very uncertain time for the region and the world. Our topic today focuses on the impact of the risks for the MENA region, especially the GCC, including the energy and macro environment and the economic development plans. Following the US involvement, many questions remain. How was Iran's nuclear program affected by US attacks? How is the regime reacting to the hit to military leadership and infrastructure? And in particular, how will Iran and other actors respond? The latter will frame not only pathways and off-ramps going forward, but also what economic impacts will be in the region and in the global economy. For the global economy, the link is primarily through the energy price risks, which, as the panel we were chatting before this started, have been remarkably subdued because energy flows have continued. But also, how will GCC countries respond as the relationship with Iran and the US is evolving? At the time we speak, regional players like Qatar are bracing for Iranian retaliation, and I believe that's currently ongoing. Insurance costs, even before this, were spiking in the region from lower levels, and some container ships and tankers were avoiding the Gulf. And also, we have the risk relating to the kind of evasive techniques that have pervaded in the energy market due to Iran's use of the shadow fleet. We will, of course, touch on risks to the Strait of Hormuz, but also other risks, and look at what all this means for the economy. With that, let me briefly introduce our three panelists so we can get on to the meat of the discussion. Alia Moubayed is an experienced economist and policy practitioner with more than 25 years of experience in government, international financial institutions, think tanks, and financial markets. She's currently the chief economist and strategist for the Middle East, North Africa, and Pakistan at Jefferies, an investment bank based in London. And I know someone I've turned to for insight on the region for many years now. Next, we'll move on to Justin Dargin. Dr. Justin Dargin. Dargin is a senior visiting fellow at the Middle East Council on Global Affairs, specializing in the intersection of Middle East energy markets, geopolitics, and climate change. Previously, he served as senior MENA energy and climate scholar at the University of Oxford. And I believe Justin is joining us having just left Doha, so can share some views from his recent discussions. And finally, we'll have Dr. Harold York, who is the non-resident fellow in energy and global oil in the Center for Energy Studies at Rice University's Baker Institute for Public Policy. He has over 30 years experience working on strategic issues shaping the energy and mining industries. First, I'd like to turn to you, Alia. Could you share your thoughts on how heightened geopolitical risks are impacting the economic outlook and even fiscal planning of the GCC states, and how investor confidence and the outlook is evolving?
Thank you very much, Rachel, and thank you for the Gulf International Forum for inviting me at this very timely discussion amidst heightened geopolitical risk and uncertainty in the region, probably one of the highest we've seen over the last few years. Obviously, Gulf economies are extremely and directly and indirectly impacted by geopolitical risk and uncertainty. But also, I think they are currently impacted by the discussions about the variety of potential scenarios and outcomes of the ongoing confrontation between Israel and Iran. I think on the positive side, geopolitical risk has been playing in favor of most of the GCC economies by the nature of them being major oil and gas exporters, with oil prices on average higher over the last few days than it was over the last few weeks. Having said that, it's important to know that still oil prices remain approximately $10 lower on average year to date than the average in 2024. But I think the recent spike in oil prices has given a sentiment that absent any disruption to the production supply and export of hydrocarbon from the region, the impact is positive as long as most of these countries are able to produce and export their oil and gas. And this will translate into improved fiscal and external positions to most of the countries. And I mean, in particular, the most vulnerable countries that fare much worse with lower oil prices, and notably Bahrain on top, given that it relies most on oil export and hydrocarbon revenue for its budget. And has one of the highest fiscal break-even point, exceeding $130 to the barrel. And also Saudi Arabia, and to a lesser extent Oman. So I think for these three countries, higher oil that we have seen over the last few days, even though oil prices have come down, was a welcome sort of boost by geopolitical risk. And this will help them also, particularly for Bahrain, contain the drain on their thin foreign exchange reserve. But I think on the negative side, I think the investor sentiment was negatively hit, whether by uncertainty about the duration and the likely path of the conflict, but also the perception on whether we are moving towards a de-escalation scenario or a mission creep and an escalation scenario that could bring Israel to hit potentially Iran's oil facility, and that could, in the market's perception, could imply a spillover and higher risk on oil facilities in the rest of the region. So I think this investor sentiment will dent, of course, private investment flows, and will keep governments on their toes in terms of their ability to deliver on their fiscal and structural reform, and that will obviously impact their non-oil growth in the foreseeable future. But overall, to be honest, I should say that when one looks at the market, markets seem to be shrugging off completely the risk, whether you see it in regional markets, equity markets that are some of which, like in Kuwait, have been closing in the green yesterday. Today, with the Qatar, I mean, we've seen the Qatar hit after the close in market, so probably depending on what happens next, we will see a muted impact. And also, again, the oil prices since this morning have been down almost $2, confirming that concern around the Strait of Hormuz and the potential disruption there is completely disregarded, and markets are very complacent about the benign scenarios of the current conflict.
Thank you very much, Alia, we'll come back to some of that. Maybe I could turn now to Justin on that point of the energy infrastructure, particularly Qatar's LNG infrastructure, and how you would see the risks in the face of hybrid threats, and what sort of strategic are there any strategic redundancies being developed either in the region or elsewhere to address some of those risks and ensure export continuity?
Great. Well, thank you very much, Rachel. I would like to preface my response with something that I think within the global media conversation about missile strikes and also maritime blockades, I think that we're missing one of the bigger pictures, one of the bigger shifts that has been occurring in that this is actually the first war, I would say, that is being shaped by AI. This is something very important that I think that we need to consider because it's going to forge the nature of warfare going forward. So if we see even the precision strikes that have occurred in Lebanon, previously Syria to a certain degree, and then also in Iran, real-time assassination decision chains that have decapitated the leadership, of course, from Lebanon all the way to Iran, even within a period of 30 minutes when some of the senior commanders have left their homes to seek safety, they have been struck. And also the missile defense triage systems as well. I mean, so we can see that AI has been one of the major factors behind the stunning, I would say, successes that Israel has had in terms of the decapitation of Iranian senior leadership, or even the supreme leader is not safe. So I would just like to, draw attention to that, and that we can see that we're no longer in a type of conventional warfare. I would say even we're in a type of algorithmic battlefield at the moment. So I just want to bring that to attention. But to pivot back to your question, Qatar's LNG infrastructure is amongst the world's most advanced and also most fortified, and then also some of the most centralized. So even in today's environment, we can see that resilience is not merely about who can build the tallest or the strongest walls, but it's about trying to anticipate some of these emergent forms of attack, which are not necessarily traditional, but which have evolved and are becoming much more hybrid. So we've had wake-up calls in terms of these hybrid threats. Back in 2012, we do recall the cyber attack that was undertaken against Ross Gas. And while it didn't impact the upstream production, what it did do was it attacked the soft underbelly of its IT systems. So what happened was it affected some of the shipping, let's say, technology, not shipping technology, but in terms of the shipping infrastructure, logistical infrastructure that was in place. And then what it also did was it sent a very clear message to many of the Gulf producers that their operations have the potential to be paralyzed, digitally paralyzed, without even a single missile being launched. So today, the threats against the Gulf producers, if we look at Qatar, Saudi Arabia, and so on and so forth, are quite hybrid and they're multi-domain. So we do have their traditional kinetic threats, missile strikes by state or non-state actors, drones that we've seen coming out of Yemen. But cyber intrusions are extremely important. They can impact the SCADA systems and also impact the safety protocols and so on. And then also there's the issue of disinformation or psychological operations as well. These have been underreported to a certain degree, but they have been taking place over the past 10 years or so, which indicate the evolving nature of warfare that is occurring within the region. So Qatar has been quite proactive in how it is considering its potential responses to these threats. Qatar has a quite robust layered air and missile defense system with aligned with the U.S., its major security partner. And then it also has implemented cyber drills and also cybersecurity modernization to the tune of billions of dollars that have been invested in various facets of this. And also Qatar has hardened Ras Laffan. So what you see is much more segmented networks and also predictive cyber prediction ability. And then also, of course, the 24/7 naval protection, which is aligned with the U.S. Fifth Fleet as well. But I do want to just point out that one of the major factors of this is that resilience is not just defense. So we have to look at redundancy. So Qatar, in addition to this, has also been exploring alternate export routes, potentially through Oman, in terms of flow diversification. It has also been looking at floating storage and regasification units as well for flexible delivery options, and also rapid IT fallback systems as well for real-time monitoring. Quite significantly, also, Qatar has been engaging over the past few years in business wargaming, continuity of operations, as well to factor in the evolving nature of these new threats, the hybrid threats. And then also we are seeing the emergence of joint Gulf war contingency planning. So the thing is that when we look at the Gulf today in terms of energy security, it is not the physical element that we have to focus on per se, boots on the ground, such as protecting tanker convoys or guarding oil fields. We have to look at what I would term digital sovereignty as well, control of the narrative, and then the ability to continue to deliver within the region, even in the fog of cyber, kinetic, or psychological warfare. So I would say that Qatar is being quite proactive in this. Qatar is not invulnerable, nor indeed is any country, but I think that Qatar has its LNG infrastructure has emerged to become much more resilient and also adaptive in the face of these hybrid threats.
Thank you, Justin. And also thank you for framing this and reminding us of the importance of AI, drones, a whole different sets of threats that have sort of materialized, including range of sort of cyber threats and the like. Turning now to you, Skip, could you share your thoughts on sort of what you're watching for in the oil markets? I mean, things that Alia sort of mentioned some of hers. What immediate and medium-term impacts would you see the conflict potentially having on oil prices, supply security, and even refining margins? I mean, obviously, there's a lot of scenarios here, so maybe share with us how you're thinking about them.
Yeah, I think I want to emphasize what Alia says. That we've seen really sort of when you think about the magnitude of what's happened over the last 10 days, we've seen a surprisingly modest reaction in oil prices. Prices are up about $7 there, which is about a 10% move. And really those prices are moving for two reasons. One is, refiners have, for about 10 years now, have had a strategy of minimizing their working capital by holding as little inventory as possible. And when this conflict started, you might have had refiners saying, well, we're not holding enough oil in inventory, so we need to go out into the prompt market and buy some more barrels that are already on the water. So they're not buying barrels for July, they're trying to get more barrels in June. And we saw some elevation in prices like immediately right after the rocket attack started, the Israeli rocket attack started. And at the same time, when those oil prices move up, if you're holding future contracts and you want to stay balanced as oil prices, and you're holding call options on those contracts, as oil prices move up, you need to take out some more call options in order to keep yourself what's called delta neutral. In order to take the directional risk out of your portfolio. Well, those two forces work together, and they should drive each other and drive prices higher. Now, the combination of those two resulted in a 10% move in prices, which really is not a very big move in the scheme of things. And I think the reason for that goes back to what Alia was saying, and I think, Rachel, you said it to me in your introductory remarks, is the market's perceiving that the probability of the Strait of Hormuz being closed is very low. And I think what the small price increase is telling us is that either the probability of the Strait of Hormuz being closed is very low, or if the strait were to close, that the impact on price is small, either because of alternative supplies in the world, or the duration of the closure would be very short. And it's a combination of those three factors is keeping the price increase fairly low. Now, what I just want to add is a cautionary note, because often when people talk about how the oil market is well supplied, the first factor they tend to mention is OPEC plus spare capacity. Unfortunately, almost all of OPEC Plus's spare capacity at this moment sits inside the Strait of Hormuz. So if we're in a world in which the Strait of Hormuz is interrupted, not only do we lose the 20 million barrels per day of crude and products that's flowing out of the strait, we also lose the ability to tap into that spare capacity. So the market's not quite as well supplied as I think the market thinks it is. But nonetheless, we've not seen very much movement in prices. In fact, since we've seen the reports on the wire that the Iranians have launched missile attacks against Qatar, prices are actually fallen another $1.50 in the last 30 minutes, which is really sort of surprising. So the market seems to be very sort of comfortable that the risk of that strait is being managed. And I think the market also is anticipating that all the principals involved understand this is a no-win situation for any country. No country wins if this strait is closed. And I think there's sort of the market's then presuming that calmer heads are going to prevail over the long run. And unless there's some sort of miscalculation, the strait will remain open. Now, in terms of refining margins, we sort of ended 2024 with sort of margins had weakened throughout 2024. We saw a strengthening of margins through the first 5 months of 2025. Then we saw a little bit of wobbling in margins in May as crude prices started to move up even before the conflict erupted. We started to saw crude prices starting to move up and margins started to weaken a little bit. Now, in the last 10 days, those margins have re-strengthened, largely led by gasoline, by diesel and jet fuel, which isn't surprising because when you start to move towards a military posture, it's diesel and jet fuel are the primary fuels used by military activities. So it's not surprising that we've seen strengthening in diesel and jet, and that's pulling the refining complex up. So we're starting to see a return of those refining margins. They haven't spiked, but they've really kind of recovered from the softening that we saw in the month of May. The last thing I want to add is we're talking a lot about oil prices, but when you're in the Strait of Hormuz, you also need to be talking about gas prices because the Strait of Hormuz is a pathway for 20% of the world's oil. It's also a pathway for 20% of the world's LNG. So closing that strait is not only going to have global implications for oil markets, but it also has global implications for LNG markets. And we're seeing that in gas prices in Asia and in Europe have also been moving up since the conflict erupted about a week and a half ago.
Yeah. Thank you very much, Skip. I think you're very right, and I think obviously on the gas side, we've seen this story for much of this year, that especially with the colder winter in Europe and prices sort of going up as Europe continues to avoid Russian pipe gas and really rely on LNG. We're coming at this time of European injection time, right? And I know some Asian countries have not wanted to pay what the global price is, but as we get towards the timing this summer will be, I'm sure, very interesting to watch. And I think in general, this element that we maybe will get into a little more as our conversation goes on, of how the redirections in energy trade and relooking at supply security in the wake of remapping Russian supplies globally, how that changes who's particularly vulnerable. Of course, as I think you've all mentioned, these commodities are very much global markets, and so no one is particularly immune. But let me turn back to you, Alia, for sort of your response to anything, sort of anything that Justin and Skip have mentioned, but also your thoughts on you've painted, I think, a picture that most of the GCC countries are entering this moment at a time of somewhat strength. There are particular vulnerabilities, or at least that there's some long-term strengths. How would you see this investor sentiment that you mentioned? How does this impact some of the economic diversification strategies? There were a lot of big investments pledged when President Trump was in the region just a few months ago, though to me it feels longer than a few months ago. How would you see regional policymakers adapting to, what's really been a year of so far softer energy revenues as they look for these longer term trajectories? How do you see them adjusting or likely to adjust to these scenarios?
Sure. I mean, I think this is a question that we are asking ourselves: is what would this prolonged, a potential prolonged period of instability, whether it could derail these diversification strategy? I think it won't derail them, but it could certainly delay them.
Sure.
Should at least in the short term, as the countries need to rethink their immediate priorities and reallocate resources. But I think the reason why I think it's only a delay and not a derailment is that first, many of these countries, the diversification drive is really well underway. I mean, needless to say that in the UAE, this has gone. They are much more advanced than anyone else, and leading the way towards a second or third generation of diversification out of services back into an artificial intelligence sort of supported and led growth. But we'll talk about that. But I think for the rest of the GCC, Saudi Arabia and Oman are implementing consistently their diversification strategy. And I think this is priced in the market. I mean, usually if you look back at periods of fall in oil prices, how credit spreads in both Saudi Arabia and Oman have reacted, you would have expected a significant widening, because in the 2015 period, credit spread were closely correlated with oil price volatility. Today, even with lower oil prices and fiscal break-even points, we are seeing tighter spreads, both in Saudi and in Oman, speaking partly to this idea that those countries not only have managed to rebuild their buffers, but they have improved on their credit worthiness, and they are determined to stay the course with diversification strategies. In Kuwait and Qatar, it's a little bit schizophrenic, because these countries have really not diversified away from a hydrocarbon, whether on the fiscal side or on the external side. But yet their very strong buffers, whether at the central bank or in their sovereign wealth fund, have been able to mitigate the risk. And I think there is also a growing conviction, also in general, whether through statements of policymakers, of the benefits of accelerating structural reform, notably in terms of crisis. That's the second point I would like to stress. And today's announcement, I think it was yesterday or this morning, that Oman, for example, re-announcing that they are going to introduce the personal income tax, which was the next generation of fiscal reform that markets have been waiting for, and even credit rating agencies were waiting for it in order to take back Oman or boost Oman's chances to move back towards investment grade rating. Oman just announced these reforms today amidst the current crisis, just reconfirming its commitment to diversifying its period. So this is why I think I'm not really worried about certain countries, but more worried maybe about Bahrain. And the other reason the other issue that could delay is if the current crisis is prolonged, is further denting private capital flows and FDI flows in particular towards the region. And this region has been lagging behind other emerging market countries in terms of its FDI attraction. And I think it is here, even the Saudi authorities have been looking very carefully at why they have not been able to attract more FDI than previously. and certainly FDI flows can be affected. My final point here is really about what these countries will do to balance the fact that they could win a little bit from higher oil prices in the short term. I think the best case scenario is where they use these windfall both to rebuild some of the buffers they have lost over the last few months, but also continue to support growth in through public investment where fiscal space allows, particularly maybe in Saudi, in Oman, in order to make sure that non-oil growth continues to be moderate and contributes to job creation, particularly in those two countries that are demographically challenged and youth unemployment is relatively higher than in other countries. So I think this is what we need to see in order to continue the course, at least on the diversification strategies, continued structural reform in the midst of the crisis.
Thank you, Alia. Well, I have you, and maybe we can follow this up in more detail. I think you've rightly highlighted, I think that commitment. I'm wondering how you're thinking about countries like, in the broader region, places like Iraq, places like Egypt, and others. I know it's a bigger question, but how in this element of if investors are still a little bit more cautious, and some of the GCC countries are maybe looking a little more at home, how are you thinking about these countries?
Yeah, I think Iraq is one of the most vulnerable, despite the fact that now, as we speak, they have a significant amount of FX reserves that they can use. But what we've learned about Iraq is that they are very quick at drawing down upon their FX reserve, given the rigidity of their budget. And obviously, the more heightened geopolitical risk in Iraq, the sort of more dominant influence of Iran into the Iraqi politics and economic footprints make Iraq less investor, I would say, friendly or conducive to private investment in this period. Egypt, on the other hand, will be mostly affected by higher oil prices negatively at a time where its external position remains relatively fragile, even though they've managed to build buffer with support from the GCC, but with continued under performance under IMF program and reform. Egypt, in a positive scenario of a return to diplomacy, peaceful deal, no more Houthis attack in the Red Sea, opening up of the Suez Canal. This is the only upside scenario for Egypt in the short term. But otherwise, I think Egypt remains vulnerable to higher oil prices, particularly that it is seeing its gas production and also export of gas from Israel to Egypt being rationed or not coming through as expected, and this will have an impact on growth. And I think the response is here again to accelerate reforms and make sure, and particularly on the exchange rate and on the fiscal side.
Thank you very much. Turning to you, Justin, you mentioned in your last remarks about the way in which Qatar had been thinking about the alternative, export routes and the like. I'm wondering if you could share any thoughts about how other countries are thinking about that on the oil side as well, or any sort of dynamics that you're seeing about how global energy supply chains are being rerouted in ways to try to increase efficiency. I know that you have spent a lot of time thinking about sort of renewable energy, climate, sort of a change-related, investment. How are you thinking about the different sort of stockpiles and elements of trying to build resilience?
Yeah, sure. I mean, well, I see that how many of the traditional buyers of oil and even LNG, that the way that they are attempting to consider if there's any type of prolonged disruption that in maritime trade that is going to emanate from the Strait of Hormuz. Well, we have to look at what precisely is the scale of exposure. As been stated earlier, nearly about 20% of oil and roughly about 25% of LNG transits through the Strait of Hormuz. So, I mean, this is quite significant. So, what we have is that even though the oil market in the Middle East is extremely, let's say, resilient, at least psychologically, I could say, in the sense of sustained unrest or geopolitical flashpoints in the Middle East over many decades, we still do see that with any type of a closure, there would be a spike, of course, in insurance premiums. This goes without saying, and then also rerouting costs. But again, even though there has been even normalcy, I guess you can say, in a sense of how military flashpoints are being understood within the energy sector in the region. But still, I think that there would be a psychological shift that would occur with any type of blockade or any type of disruption in from the Strait of Hormuz in terms of energy trade. What I see is a type of upon the horizon, if the conflict continues, is a resurgence in strategic stockpiling. And I would say not with the usual suspects within the West per se, but I would say we would begin to even see this within Asia and other buyers in the global South. If we look at China, India, or even Southeast Asia, so we can see that they would accelerate their SPR build-outs as well, and then we could see that many of the traditional buyers would shift towards holding more of their physical inventories much closer to their demand centers. An additional aspect of this is that I see a type of reckoning, a forced reckoning, even in the sense of corridor redundancy within the Gulf region. And I think the implications of this are quite vast, even momentous. So we can see that many of the Gulf countries are exploring, let's say, diversification of their export routes. We've seen that the UAE has been considering this, and even Qatar. So this potential disruption, and the conflict is pushing the envelope in that regard. So we can expect fast track pipeline diplomacy that would occur between Oman, let's say Qatar, and the UAE as well. We could see also expansion of Red Sea terminals as well, and also storage infrastructure, and even perhaps deeper investments in the Mediterranean and potentially East African ports in order to hedge assets. So this could be, as conflict often is, a type of impetus towards a deeper Gulf energy integration upon the future. And pipelines have always been a bone of contention within the region, as we've seen that, let's say, the Dolphin natural gas pipeline initially was supposed to be a pan-Gulf natural gas pipeline, but now the Dolphin pipeline is the pan-Gulf gas pipeline in a much more diminished form. So I think conflict would expedite this type of Gulf energy integration, at least in regards to pipelines. And then also, I think if we look at LNG infrastructure within the region, or excuse me, not infrastructure, I would say LNG geopolitics. So we can see that with many of the traditional buyers, security of delivery is going to begin to take precedence, perhaps even on par with pricing. So LNG buyers within Europe, Asia, and elsewhere are going to increasingly favor suppliers which would completely bypass or avoid the Strait of Hormuz. I could even see that contracts, would begin to be rewritten that would begin to price in this delivery risk, and alternative suppliers, the U.S., Australia, even within East Africa, would begin to benefit from this. So this is where innovation would begin to take hold within the region. So perhaps a shift towards decentralized LNG assets, We can see perhaps there would be much more investment in floating storage units. We could even see perhaps modular regasification terminals, even mobile infrastructure designed to give buyers a much more of a sense that exports from the region would be quite resilient. So Gulf exporters, what they have to do, they must demonstrate that they are going to be quite credible in the creation of crisis-proof delivery for their buyers, and that they also have geopolitical agility. So all in all, if there is a blockage of the Strait of Hormuz, we have to understand that this is not necessarily just choking trade. Rather, this would also choke confidence in the region to be able to deliver on its promises. And I think that this is actually the deeper risk that the region would have to confront.
Thank you, Justin. And I think that element of choking would also, we focus a lot and we're focused a lot in this conversation about, oil and gas flows, and it's very important and very strategic, but anything persistent blockage makes, even other trade more, sort of more complicated and re-export. I think you also raise a really important point about contracts being rewritten. We've already seen in some of the Asia contracts a desire for more destination flexibility, particularly in their contracts with like Australia and the US, and including around tariffs. And so it will be interesting, I think, to watch what areas of flexibility and, what is your sense about how the Qataris are thinking about sort of more flexibility. I know they've historically been quite resistant to destination flexibility contracts, but their plans are to bring quite a lot of LNG online in the between now and 2030, right?
Yes, absolutely, absolutely. So the Qataris, of course, have been quite resistant in terms of this new type of contractual flexibility that has been on the horizon, and that, of course, the U.S. is much more able to provide. But given this, the Qataris have recognized that it is much more desired for them to be able to offer this towards their traditional buyers. So what we have seen is that the Qataris, while on one hand, they do want to have predictability in terms of their export contracts, but they have been able to loosen some of the more structural stipulations that have been concerning buyers. So we've seen this, for instance, with many of the European contracts as well, and we're starting to see this flexibility embedded within contracts in Asia. And there are various aspects of contractual flexibility that we have to remember. So one aspect of flexibility is in terms of what pricing model you are going to integrate into your contracts. So are you going to have it align with, let's say, the oil prices, or are you going to have, let's say, much more standalone pricing models that are going to be based, let's say, on the merits of natural gas by itself? So we've seen that the countries are becoming a bit more flexible with this, and I believe that as the competition intensifies in the global LNG market, of course, with the U.S. increasing its LNG production potentially on the horizon, the LNG glut that is occurring, Australia and also other emergent producers, by necessity, countries are going to have to become much more flexible in order to become the world's number one LNG exporter, which is where they want to go to.
Thanks very much. Turning to you, Skip, I want to get your thoughts, sort of just to follow up on all of this, on how global sourcing may be shifting or particularly be affected by any significant outages. I think particularly, any thoughts you have on the big Asian buyers, but just, more generally, I mean, I think we have an interesting dynamic in the last few years where India has paradoxically become less directly affected by the Strait of Hormuz, and maybe more or supplies that are coming from the Gulf and the MENA region. But how are you thinking about how the role that Gulf producers can play at a time of this sort of geopolitical volatility? What other shifts are you expecting to see, either on the crude oil side or the refining side, right, where we've seen, of course, a major geographic shift, right?
Yeah, I think one of the things is I'll just circle back to the conversation you and Justin had about contracts, because as we were getting ready for this webinar, I was thinking about,
Mm,
what role does contracting play? And I
mhm,
think one of the places where the corporate energy companies may have an advantage over the NOCs, specifically in LNG, is we're talking about destination clauses, but one of the advantages corporate LNG players might have in managing, um, call it infrastructure risk, is this supply portfolio mentality that many of them have. Shell is
mhm,
actually incredibly good at it, right? Shell does a very good job of saying, I have a contract where I have to deliver volume to this location, but I have a number of supply places where I could pick up volume. And so if there's a disruption, and we're looking at the Strait of Hormuz today, but that's not the only place where you could have a disruption. If
sure.
you've got a number of supply sources, you're in a much better position to be able to deliver on your contracts than if you only have one supply source. And then, there's a theory, McKinsey and Company has done a lot of work on pushing this idea that you want your sources and your sinks to match up numerically
Mhm,
so that you have this portfolio flexibility. And I'm kind of wondering, how do you actually, if you're a Gulf producer, whether it's in LNG or in oil, how do you could you replicate that in a contract? And of course, no contract protects you if your infrastructure has been impaired. No contract protects you in that environment, because you don't have the ability to deliver volume unless you've got an alternative source. So I'm kind of thinking, how do they actually deal with that? And I think one of the things they can do is they just do more of what they've already been doing. And we kind of alluded a little bit to this, but just to draw it out a bit more about, both
mhm,
Saudi Aramco and Kuwait Oil already have, on the oil side, they have storage positions outside of country. The Saudi Aramco has positions in Japan, Netherlands, and the Bahamas. Kuwait Oil has positions in a number of Asian companies in the Netherlands. And originally, those storage positions were built to take
mhm,
advantage of time spreads. So it wasn't in the
mhm,
event that there's a disruption in my flow out of the Gulf. They were actually built for, in the event that there's a time spread arbitrage that opens up, and somebody has a crude contract with me, I can capture part of that time spread by delivering crude out of one of my storage facilities rather than sailing it all the way from the Middle East. Then I go ahead and sail the volume out of the Middle East and I refill my storage facility in the Bahamas, for example. I think maybe there's going to be a world of that in which there's going to be more room to forward deploy, or there's going to be the economics of the security of supply and the economics of deliverability is going to reward the ability to forward deploy and forward
mhm,
store volumes outside of your producing region. Now that works in oil, that works in crude oil, and that works in products. I think it becomes a bit more difficult in LNG, right? Because that is just a very difficult commodity to store. On the flip side, I think you're going to see consumers doing similar things to, like you were talking about with India. I think we're going to see consuming countries probably doing more of what they've already been doing, right? They've been diversifying their supply sources. Largely, they were enabled by the shale revolution in the US,
mhm,
opened up a brand new supply source on the crude side and on the product side for them to go and diversify their supply sources away from sort of the traditional supply places like West Africa and the Middle East. I think they're probably going to look to do more of how do they do that. And I think the way they do it is, it's not like we're going to have new planets to be drawing oil from, or new
mhm,
countries. But maybe the way they do it is they return to something that they were doing, 10 years ago, which is taking upstream positions, or similar to the to the NOCs, building storage hubs themselves. They don't build them
mhm,
in India or, in country. Maybe they build storage hubs in storage facilities in trading hubs. And that way, the oil just isn't sitting there latent. They trade around it, because as a refiner, as a consumer, they're going to have these arbitrage windows are going to open up, and they're going to be able to play those arbs if they've got
mhm,
volume to play with. So I think what we're going to see is, infrastructure is going to become important. In particular, the way we're going to manage crises like this going forward, not just with the Strait of Hormuz, but any supply interruption, the ability to maintain store infrastructure, specifically storage, becomes more and more valuable as we're looking to mitigate sort of supply interruptions.
Thank you, Skip. I think that's right. I also think, I mean, sounds like both at the consuming country side, especially those that have the capacity, and as you say, the sending companies, that desire for sort of more flexibility. I'm conscious of the fact that after a period of drawing down of their inventories, we've been seeing China buying, sort of refilling their stockpiles. There's been a fair amount of volatility, it seems, as best we can measure. But also this question mark, what about floating storage? Some of that is an Iran story of trying to get, fuel away, but it seems like this might be a bit more of a complicated scenario and the like. I'd like to remind our audience that if they have questions they would like this panel to address, to please feel free to post them. I mean, I have no shortage of questions. I can keep peppering, but we also want to make sure that you, our audience, get to answer them and the like. I wanted to turn back to you, Alia, and ask about how, to what extent are you seeing regional coordination to, I guess both on the security side, I think you've sort of alluded to, but on the economic side, are you seeing more economic coordination to try to buffer sort of this fallout, or more, or other dynamics? Are there any shifts in sort of collective organization across the GCC? And I guess related to that, are you seeing any signs about the ways in which this conflict that has really been a part of a long-standing one, how there might be shifts in foreign policy alignment?
I mean, on the coordination, of course, I think there is, in times of crisis and heightened geopolitical risk, we have seen the GCC coordinate more closely on a rather a common position, i.e., calling for de-escalation, working through back-channel diplomacy to help move in that direction, and also obviously work to coordinate within the OPEC Plus in order to ensure that the backdrop for the oil market is conducive, is not would not render any crisis more acute or more complicated. Having said that, I think there are clear differences in terms of the long term. The long-term vision in terms of cooperation and regional cooperation, at least with Iran, but also on the path towards normalization with Israel. All these are important economic decisions that will shape the future of the regional economy, the flows of capital, of finance, of trade. And I think these discussions have not yet sort of moved to a scenario where what will happen if there is a de-escalation scenario and a move towards a deal that takes oil prices in such a scenario to a much lower level, and that could impact each country differently, and therefore could dent this cooperation and coordination down the line, because we would be possibly in a more competitive approach to oil production and oil export, and potentially a race to the bottom. So all these questions, I think, are on the table. But again, as I mentioned previously, they all depend on whether we think the current scenario of manage instability, will keep oil prices where they are, or we move to a scenario of de-escalation that could take oil prices even much lower.
Mhm. No, that's right. And I guess then you even get into the coordination issues more broadly in the OPEC Plus group, with countries like Russia, some of the
Yeah.
other sanctioned, and those dynamics. Justin, I mean, feel free to share any thoughts on that question of coordination, but I'm also interested with your decarbonization focus lens on and shift in energy sources, particularly at a time where we know that electricity demand is going up, the sources are shifting. How, sort of how are you thinking about how the impacts of this conflict on long-term decarbonization pressures on the Gulf countries or even some of their buyers? Would you see it speeding up, slowing down? I know it may depend on which parts of the world we're talking about, but how does this map with decarbonization and sort of power mix questions?
Yeah, thank you, Rachel. That's a great question. In terms of your first question, just to build off a bit on what Alia discussed, the fear, I would say, of Persian expansionism
Mhm.
within the region. This is not anything new. Actually,
Sure.
this has been a perennial concern, even going back about 2,000 years ago. There is a battle called the Qatar, where a confederated group of Arab tribes band together in order to muster troops to fight against the Persian Empire at that time. And indeed, I think that this is something very significant if we look at it conceptually, because this was the first time in history that various Arab tribes were able to create a type of, at least the initial idea of a pan-Arab identity. Right, so
Mhm.
this even goes back 2,000 years ago. So the threat of Persian expansionism is something which sits on the minds of many policymakers in the Gulf, whether it's Shiite flavored or what have you. And even if we go back to the beginning of the GCC, the Gulf Cooperation Council, that is a security aligned framework, of course, and that
Mhm.
was established in the wake of the Iranian Revolution as one of course, the Soviet incursion into Afghanistan. My idea about this is that, of course, as we've seen even in Europe, whenever there are security concerns with a region, that tends to foster much closer collaboration. And indeed, I think that the current conflict will also bear fruit in that regard. Now, in terms of your second question, how this potentially could impact the decarbonization drive in the region. So, the way that I look at it is that the Gulf is creating a type of transformation story, a type of transformation narrative, how the region is going to transition from being hydrocarbon centric to surviving or even thriving in a post-oil world. So if this conflict endures, and if we can see it becoming much more kinetic or even in terms of cyber threats or what have you, I think that this is going to threaten the narrative. And this post-oil future maneuvering within the Gulf, it depends much on predictability, as does indeed any type of investment domain. So what this would introduce, I can see, is investor hesitation,
Mhm.
perhaps in some of the core facets of diversification within the region. Even if you look at tourism, which Saudi Arabia is attempting to promote quite extensively, finance, logistics, even clean tech, even industrialization in terms of manufacturing and what have you, rising sovereign borrowing risks as well. We can definitely see this happen as risk premiums expand, and then delays, I think, potentially within mega projects. Now, the reason I say this is that, yes, there is a clear structural need
Mhm.
for the Gulf countries to invest in their mega projects and to see them through because they need to do this. But at the same time, it does depend on being tied to global partnerships and also global supply chains. So these could be at quite a significant risk in terms of how this conflict could spill over into the various domains in the region. So overall, I think that the credibility of this economic transition is at risk, and the potential for the Gulf, as it has been portraying itself as a type of climate conscious hydrocarbon supplier, their carbon neutrality pledges, I think, could also be at risk as they start to pivot towards a more defense spending, let's say, profile. And then also these mega projects in terms of clean energy, they could face delays or even defunding. Western partners, again, could question the stability of this regional transition framework or even narrative. So overall, we can see that the main strategic battleground in terms of Gulf decarbonization, I think the foreign investor confidence could potentially lose out on this as capital becomes much more cautious. And then we can also see that the sovereign wealth funds could potentially shift from their more expansionary phase, which they've been looking outward, to becoming domestic backstoppers, let's say, and tightening liquidity in other sectors. So overall, what I would say is that the Gulf region really has to make certain that its future-facing agenda remains intact, and that it can portray to international investors that it can manage conflict without necessarily being consumed by it.
Thank you, Justin. Turning to you, Skip, if you have thoughts on the sort of this coordination sort of question, I'd be interested in that. But I'm also wondering, in particular, if there are lessons to be learned from past sort of experiences of deploying strategic reserves. I mean, obviously here we're sitting in a moment where there hasn't been a loss of output, so no need to necessarily deploy strategic reserves, but just any response mechanisms. I'm also conscious of the fact that the last time you, Justin, and I were on a webinar like this, we were talking a lot about U.S. production and the challenges to U.S. producers in this sort of, in this environment, a price environment that was a little bit cheaper than now, but we're still facing some of those sort of dynamics. I'm wondering about how in this environment, with we're sitting here having a conversation at a time when the U.S. government energy agency has predicted that 2026, I guess, will be the first year, maybe this year, where U.S. production of oil might go down. Forecasts are always forecasts, but where does not only the countries in the Gulf fit in terms of their sort of strategic reserve standpoint, but are there any elements where sort of thinking about the U.S. sort of role in this in this sort of environment? So I know I threw you 3 questions, so feel free to answer any of them.
Yeah, so when we think about strategic petroleum reserves, I think we come back to 2022, and there was a valuable lesson we learned. There was actually this really fascinating analytical paper done by some folks at universities in Canada. And what they discovered is it's actually possible to panic a market by drawing on your reserves too quickly and too hard. And what they showed was by the US drawing on the SPR so fast and so hard at 1 million barrels a day starting for 90 days, and it actually continued longer than that, that oil prices actually ended up being higher, because what it did is it induced panic, because it created an environment where participants in the market thought it must be worse than I think it is, because look at how much oil the government is putting onto the market. And they actually started chasing barrels, and that drove up prices. So I think the lesson here to be learned is you've got to get this timing right. If you're going to draw from your strategic reserves, you've got to get the timing right, where you don't want to wait until there is a crisis, because then it takes time to get those barrels out of storage and into the market. But you also don't want to go too early, because then you create a sense of panic about what does the government know, and the market creates this panic about what does the government know that I don't know, because they're making a move that I don't see them that needs to be made, and you want to avoid that reaction as well. So I think, it's an art, not a science, and I think that's the cautionary tale. We're also in a world where, for most of the strategic reserves, and I'll pick on the U.S. and general is that the U.S. is starting, we're at about a little over 300 million barrels. So we have a healthy amount of reserves, but it's half what it was at the beginning of the Russia-Ukraine war. So we drained off about half of the strategic reserves, and we really haven't added much back in since then. So, it's a bit like the Federal Reserve Bank will say that they want to be careful about when they're talking about cutting interest rates, they want to be careful about how many times they fire the gun, because once you cut rates, that limits how many more times you can cut interest rates. So that's the other. You're starting from a position of you only have 300 million barrels, and you really can't pull all 300 million barrels out for technical reasons. So that's sort of the cautionary. Now, the good news is, as I'm watching the screen while we're going through this webinar, the market's clearly telling us the market doesn't see any need for us to be talking about an SPR draw by any country. So that's good news. When we were on the last webinar, oil prices that you and Justin and I did together, oil prices are up about $10 from when we did that webinar, and we're still pulling rigs out of the field in the US. So, producers don't yet see that price signal. And based on what we're seeing on today's price movements, they still don't see the price signal that they need to see in order to put rigs back into the field. So we're still on this, like the EIA's estimate, and I think we're building a consensus where oil production this year in the US is going to be flat. Possibly by the end of the year, we might actually start to see a slight decline. 2026 might be in, a more accelerated decline. And that's all being driven by market economics, because the US producer does not respond to a government agency or a government mandate. They're all private producers, private and corporate producers. And the one thing that they all have in common is they will respond to price. And we are not getting a signal from the market that they need to be changing their production decisions or their capital deployment decisions. The good news is, were the market to change and we need that production decision, shale still reacts relatively quickly, more quickly than other sources of oil supply. But it's still, 10 to 15 weeks. So if we actually need a material response from US supply, it's going to take about 3 months before it happens, even if even if it's an all hands on deck sort of moment for US producers. So, I think and I guess that's where the SPR draws come in, is that you get that price signal while you're waiting for that quick response force to show up from US shale. You can use your SPRs to sort of stabilize the market, and then you get the volumes coming from out of the US production. And just everybody just needs to keep in mind is that, because I was asked over the weekend, would the US ever put in export constraints? And I was like, well, that doesn't really make a whole lot of sense, because US refiners don't refine the crude that's being exported, because they already have the option to run that crude, and they're choosing not to run it because of the way the refineries are configured. So export constraints would actually be a destabilizing move for the US right now. And it would be the same thing if you had an increase in shale production. What you want to do is leave those export taps open and let that crude flow out into the world and flow to those places in the world which are experiencing supply disruptions.
Sure. No, thank you. I think we're at the time for closing remarks. We seem to have lost Alia. Oh, right. Alia's rejoined us. Wonderful. I think maybe Alia, you could kick us off with some closing remarks. Anything you want to make sure to leave us with, and particular any major risks that you're watching if this continues. Oh, maybe we don't have her audio. Maybe, Justin, I could turn to you for some closing remarks, and we'll circle back to Dr. Alia.
Yeah, sure. Yeah, sure, absolutely. So one thing that I consider is that why hasn't the market reacted as much as we thought it would have reacted to this conflict? Okay, and the way that I see it is that it would take a true black swan event, such as has been explicated by Nassim Nicholas Taleb in the book his book titled Black Swan, which is basically an event which was completely unforeseen. So we have been speaking about a potential conflict between Israel and Iran, or the US and Iran, over, I don't know what, the past potential 15 years or so. So I would say that we have already normalized this to a certain degree. This is something that we've already expected, or even, let's say, during, I believe it was during the Bush administration, they said that what, there are the known knowns, known unknowns, and the unknown unknowns. So what I would think is that the market now is only looking at structural issues. So is there going to be a structural impediment for export from the region or production in the region? And how is this going to impact the global oil market? And I think that this is what we have to really look at. So again, we've been hearing the rhetoric, or let's say the narrative of a strike on Iran for some time. And I think that the markets more or less have shrugged that off. But overall, I mean, I believe that the region is still going to progress with its decarbonization drive, even though it's going to be under threat in case of any type of more enduring conflict in the region. But we have to remember that the Gulf region has undertaken decarbonization for its own self-interest. So the reason because is the Gulf region has been, since, let's say, the 2000s, has been increasing its own consumption of its hydrocarbons. So when you look at decarbonization is just another way, domestic decarbonization within the Gulf is another way to just say hydrocarbon demand management, so to speak. So there is a vested need within the region to be able to do so. And I think the region will consider to do that, even if there is more of a shift towards a security posture within the region, which I think is going to happen. And I think, again, there is going to be much more regional coordination in terms of the energy front, at least in terms of pipeline redundancy, and then also in terms of a collective secure Gulf security posture.
Thank you, Justin. Turning to you, Skip, any closing remarks on this topic?
So I just want to build on to something that Justin said, is like, why has the price response been so muted? And I think, if you think back to history, I can use this line. I'm old enough to remember when the Iranians actually did threaten to close the Strait of Hormuz during the Iran-Iraq War in the late 80s. And they threatened to close it, and we saw really volatile, violent changes in oil prices. Then there was the Iran invasion of Kuwait, violent changes in oil prices. And this time, same discussion, not so big of a change in oil prices. And I think there's a big difference. We've got much more transparency in shipping today than we had 20, 30 or 20 years ago or 30 years ago. We've got real-time views of it with satellites and with GPS tracking on ships. Although putting the Iranian dark fleet aside, we can actually watch in real time that ships are still loading and ships are still transiting the Strait of Hormuz. So the market can see that this risk of the Strait of Hormuz, we don't have to wonder, are there ships still transiting the straits? The market can look in real time at data that tells them, yes, ships are still moving through the straits. And I think that's part of the reason why the market response has been so muted. The other cautionary note I want to add, just as it's a risk. But I've seen some, and especially over yesterday in particular, but over the weekend, I've seen some rather irresponsible statements being made around strategic thinking. I thought there's somebody from a strategic think tank who said that if Iran escalates and expands the conflict, the United States should consider closing the Straits of Hormuz. Not the Iranians, the US should consider closing the straits. And their rationale was, you can starve Iran of its ability to fund itself and put its economy on its knees. And the US doesn't really need the oil out of the Middle East because of the shale revolution. Okay, both of those statements are fact. Closing the straits would be devastating to the Iranian economy, and the US doesn't use a whole lot of oil out of the Middle East anymore. However, the United States has a lot of allies in Europe and Asia that are heavily dependent on that strait for both oil and natural gas. And it even has a competitive adversary or a competitive opponent, whatever you want to describe China, It would also be destabilizing to China. So the United States has a strategic interest to keep that strait open, despite the fact that it doesn't use the strait. So I would just like to encourage the audience, when you hear comments out there that don't seem to make any sense, they probably don't make any sense.
Thanks, Skip, and just to reinforce your point, of course, as I think we've all kind of highlighted, these are global markets, right? And so even if the U.S. is not physically buying sort of molecules from that are coming through the straits, can't wall itself off. And I think you rightly highlighted that export controls would not create a fortress America that would be positive for a variety of other goals. Let's see if we have Alia again. I know we've been facing some connection difficulties. Alia, if you're here, please share some closing remarks.
Sure. Yes, and I mean, I think if there's one thing interesting in this episode of heightened geopolitical risk is probably that markets seem to think that this is the last episode of Iran, possibly Iran affiliated or induced or geopolitical risk, as markets are filtering in also not only the fact that they can see that the Strait of Hormuz is not going to be closed, but also are increasingly aware of the significant asymmetry in military power balances, and factoring that into the capacity of a nuisance or of continued destabilization in the region. This time around, I mean, I think the positive thing is that the containment of Iranian proxies in the region is helping to reduce risk premia significantly, once and for all, we hope, at least. And that is important not only for the Gulf states, but also for the other economies where the business environment or the dysfunctionality of this economic decision making, whether in Lebanon or let's see, or in Iraq, if we see different political configuration in Iraq emerge, can actually go in the positive direction in terms of putting economic policy priorities first, given the dire straits in those countries.
Thank you very much, Alia. That's a great way to end, sort of our discussion of things to watch. I have a feeling we'll all in different configurations be gathering to talk about some of these issues soon. So it just leaves me to thank our three panelists for today. Dr. Alia Moubayed, Dr. Justin Dargin, Skip York, as well as the staff of the Gulf International Forum, and to thank all of you who joined us today and who may be viewing this webinar at a later point on YouTube or elsewhere. Please don't hesitate to be in touch. We're all happy to continue conversations on these important topics for the region and the world. So thank you very much.